In this video, you will understand why the income statement numbers are inherently biased, understand why revenue is the most critical in analyzing the income statement, know the key metrics value investors look for when assessing the quality of the revenue reported by a company, and increase your financial intelligence by 72.33%. Okay, I made this up. This is Ali, and welcome to the Accounting Analytics channel. Say hi to Alice. Alice oversees a plant manufacturing toys. Her monthly target gross profit, a figure calculated by deducting cost of goods sold from total sales, is set to be $1 million. This month, Alice was short $20,000. With her usual calm attitude, she decided to investigate the cost of goods sold. Listed among these costs is an expense titled Contract Administration on Plant Orders, amounting to $25,000. She thought to herself, well, this expense might fit elsewhere on the income statement. She petitioned the company's controller to move this expense from cost of goods sold to the operating expenses section of the income statement. Her request was approved. The gross profit target is now met. Alice got her bonus and everybody is happy. Now we introduce John Del Vecchio. John is a fund manager and a value investor specialized in shorting individual stocks with red flags, and the co-author of the great book What's Behind the Numbers, from which I borrowed many examples while preparing for this video, and you can check below for more information. John was checking out the income statement of a company named eResearch Technology, a company providing services for the medical field. John suspected that this company was involved in inducing its customers to accelerate their purchases by offering them aggressive payment terms and discounts near the end of the accounting period, so they can meet Wall Street expectations and avoid a stock sell-off. That's called channel stuffing. No worries, we will revisit this term later. The company's earnings are of bad quality, John concluded. Now, what do Alice and John have in common? If there is one thing you must get from this video, it's the following. Both Alice and John understand that numbers are like a painting, where the accountant can paint whatever picture he wants to convey. They used this fact for their own advantage, and by the end of this video, you will also be able to do the same. The income statement is a financial report issued by a company, usually on a quarterly and annual basis. It shows the company's profit or loss for a specific period, for a quarter or a year. It's also called profit and loss, statement of P&L, or statement of operations. But what is profit? You might think that profit is simply cash received minus cash spent in a period, and that's it. Well, this is called the cash-based accounting, which is completely different from what you see in companies' reports. What most companies are using in preparing the income statement is the revenue recognition and the matching principle, which we will examine shortly. The income statement starts with revenues, also called the top line, and it's our main topic today. Revenues are the most critical element to analyze in the income statement. Why? A study by the Committee of Sponsoring Organizations of the Treadway Commission, or COSO, found that improper revenue recognition schemes accounted for 61% of fraud cases investigated by the SEC. This goes against the conventional wisdom that revenues are difficult to manipulate, and we will see how. Now we discuss the matching principle. The principle states match the cost with the related revenues to determine profit in a given period of time. Let's take a look at a basic example of the matching principle in action. A company recently bought a machine that extracts olive oil from olives. In its income statement, the company will not record this purchase as an expense. Why? Because this machine will be initially recorded as an asset on the balance sheet. And since it will last for multiple years, and to match the olive oil sales revenues for the year with the related costs, it will record a portion of this asset as an expense, also called depreciation expense. So the machine will be depreciated over its useful life. But what's the machine useful life? Who can say how long the machine will last? What method of depreciation will we use? You might be thinking that there must be a specific guideline that answers all of these questions, like GAAP. The truth is, GAAP only provides general guidelines and leaves room for accountants and finance professionals to make estimates and judgment. Revenues are recorded when earned, either by shipping a product or by completing a service. That's the revenue recognition. Sounds simple, right? Consider this example. A company is specialized in creating a customized cybersecurity software for law enforcement agencies. The software requires 8 months to design and get approved by the client, then another year to implement. The customer gets no real value from the software until it's implemented and fully functional. When have the company earned the revenue? Is it upon signing the contract? After completing the development? When the software is implemented? Or proportionally throughout the life of the project? Same as the previous example, when we talked about the useful life and depreciation. This kind of question doesn't have a precise answer. And that's my main point. Revenues is where accountants have most discretion in painting the numbers they wish to. The key takeaway here is that the nature of the income statement by itself, the way it's made through the matching principle and revenue recognition, forces accountants to make judgments and estimates in nearly every line of the income statement. And what does this lead to? Bias. We are not only talking about fraud here, but we are stating a fact that these numbers are biased, and the intelligent investor is aware of this fact, understands how these numbers are calculated, and uses these facts to his own advantage. Stating these limitations, the best approach for the intelligent investor when analyzing revenue is to manage the downside and let the upside take care of itself. I'm not sure who said this quote, and if you have any idea, write it down in the comments. But I think this sentence summarizes all lessons in risk management, and I will talk more about it in future videos when discussing the Kelly criterion and capital allocation. For now, we will learn to manage the downside with key metrics value investors deploy to evaluate the quality of the earnings and protect their money. The first key metric we will discuss is DSO, or Days of Sales Outstanding. Let's go back to John. How stuffing the channel detected by him works. It's March 28th. The company made only 80% of its expected revenues. The sales team gather and pick a customer that they know for sure they're interested in their product, but is expected to make a purchase next month. They lay out that if you buy before the end of quarter, you will get an incredible discount and favorable payment terms. But how John detected this scheme? The answer lies in Days of Sales Outstanding metric. It is calculated as follows. DSO is equal to number of days in the reporting period times account receivable divided by revenue. The metric shows how many days it takes a company to be paid. Changes in DSO are a sign of changes in payment terms. The following table highlights DSO issues in e-research technology sequentially and year-over-year. Both sequential and year-over-year data show increase in DSO by approximately 4 days driven by increase in receivables despite lower revenue year over year. Soon after John issued his warning to clients concerning e-research technology, the stock price went from $13.74 in April 2006 to $6 in November. Please keep in mind that higher DSO has nothing to do with collection, but with revenue recognition. What the company is doing here is stealing revenue from future period. Stuffing the channel means there is less in the channel later, and like a horror movie, it ends badly. Another tactic to record revenue sooner is adopting a new revenue recognition policy that allows, so like the POC method or percentage of completion method. POC allows companies to record revenues based on the proportion of the work completed. What does this mean is that companies and their accountants must estimate their own progress. And what will be the result? Inflated revenue. Let's take a look at Yulvac, a Japanese manufacturer of vacuum equipment. Facing the collapse in revenues and gross profit in 2009, Yulvac decided to paint better figures by adopting a new policy in 2010. Let's take a look at the company's report in 2010. The revenue recognition changed to the POC method, and this change, the company discloses, led to an increase in net sales by 44,037 million yen and an increase in gross profit by 12,033 million Japanese yen. So, if there was no change in the revenue recognition policy, the company earnings would be as following. We deduct the effects of the change from the reported numbers to get the adjusted figures, and we find that net sales actually dropped by 21% instead of 1% as reported, and the gross profit should be minus 7,225 million yen instead of a positive 4,808 million yen. By the end of 2010, the stock price of Yulvac was at approximately 2,400 Japanese yen. It began dropping and reached its lows on mid-2012, trading at only 400 yen, and wasn't fully recovered until late 2015. The third metric to watch out is changes in deferred revenues. In accounting, when a company receives payment for a service it did not perform, it classifies this receipt as a liability on its balance sheet, an item titled Deferred Revenues or Unearned Revenues. The journal entry for such transaction is to debit cash, credit deferred revenues. Once the service has been performed, the company debit deferred revenue, so it's removed from liabilities, and the credit revenue, which will appear on the income statement. You can check my Accounting Basics playlist if you want to refresh or gain knowledge in fundamental accounting concepts. Deferring revenue is very common in software companies, where they receive a cash advance before building the software. When companies are in fear on missing on Wall Street expectations, one way to boost earnings is by drawing from the well of deferred revenues. In other words, recognizing revenues too soon. When we see a growth in reported revenues faced with a drop in deferred revenues, that's a hint for unsustainable earnings. The deferred revenue well is not bottomless, and sooner or later, as we saw with all previous artful tactics, things will be looking nasty. In this video, we discussed why revenues are the most critical in analyzing the income statement, whether because it's the place where most fraudulent activities occur, or because judgment and estimates are used to figure out earnings, which make the numbers inherently biased. Finally, we listed 3 very important metrics used in evaluating earnings quality. I hope you enjoyed this video. If you have any suggestions or comments, leave them down below, and thanks for watching.